Often combined as a savings and investment, the two are very different. Moving from the former to the latter can sometimes be daunting. However, we will all have to take greater personal financial responsibility, and more people are seeking returns from stock market investments. Knowledge and financial education are key, and with so many sources of information and social media interaction, it is easier than ever to get to grips with the basics and build a long-term investment strategy. Young people are actually relatively disciplined when it comes to money but tend to save rather than invest. By being better informed, they could benefit from the fact that over time stock market investments deliver higher returns than any other. We are committed to encouraging more people to embark upon a long-term investment strategy, measured wealth creation in pursuit of long-term financial independence. What is an investment? Money in a savings account is safe and yours to withdraw, but likely to deliver little interest. When you invest in, for example, shares, funds, bonds, wine, art or property, you are gambling that the value of that asset will increase and you can sell it at a higher price than you paid for it. You pass up the guaranteed returns and security of saving and take a risk with your money in the hope of achieving a better return. The greater the risk you take, the greater the potential profit you may make, but the greater the chance that you may lose some, or all, of your money. Not something to undertake lightly and worth spending some time getting to grips with the basics. This introduction assumes that underlying investments are in quoted companies on the stock market, whether investing in individual companies or collective investments called funds. The fundamental principle is that you invest in a company or range of companies in the hope that they will perform well and go up in value. Any stock market investment is a gamble, but education is the key to managing the risks you take. For most, investing will involve selecting a small number of investments and monitoring them over time, ensuring that they are able to benefit when markets rise and survive when they fall. A solid portfolio can deliver dividend income over time, and investing for a long duration will allow you to achieve the free money from Einstein's eighth wonder of the world, compound interest, interest paid on interest. Is investing right for me? Historically, stocks and shares have outperformed savings accounts, but that's no guarantee they'll do so in future. Your decision to become an investor is entirely based upon your personal circumstances, objectives, and response to a potential loss. Before investing, it makes sense to clear your debts, as you may be paying more in interest than you could achieve from your investments. An investment strategy is often much more effective if there is an end game, possibly the purchase of a property or school fees. Investing is a long game rather than a quick fix. Embarking upon risky investments in the hope of achieving returns to solve other financial woes is a surefire way to compound them. Investing is not for everyone. For some, the poor returns from even the best performing cash ISA may be acceptable in return for a good night's sleep. However, if you do decide to become an investor, keep it personal, set your financial goals, understand your response to risk or potential loss, and unless you are using a collective investment or using an automated investment platform, do your own research. No racing certainties from the bloke down the pub.